Module 1 here, we're just going to do a refresher of the basics of calls and puts, the two basic types of options. If you're comfortable with these basics, then feel free to skip through this section relatively quickly. But if you do feel like you'd benefit from a refresher, then stick around. So yeah, the two basic types of options. You've got calls, the right to buy an asset. The underlying asset we tend to refer to as S, S for spot, if you like. So there's some underlying asset moving around. We've got the right to buy it. Obviously, if it goes up, we'll find that right valuable. If it goes down, not so much. The other type of basic option is a put. That's the right to sell an underlying asset. You don't have to, all right, but it's the right to do so should you choose to, if you hold this option. So a put, obviously, would be thinking about selling the asset at a fixed strike if it goes down. Now, if the asset goes down. Now, I've mentioned strike here. Strike is the price at which the right can be exercised. So that's the thing to fix, literally, in your mind. If you've got a call, you can buy here something that, well, if it's up there, you'd benefit from buying at this strike, something that's higher than the strike, buy low, something that's higher. So you'd exercise your call when the underlying asset is high. You'd exercise puts, however, sell here, you'd exercise puts when the underlying is low. So if you're a holder of a put, actually it's a bearish position, isn't it? You would benefit as the underlying asset falls. You get to sell here something that's worth less. Options don't last forever. There is an option expiration, 1 month, 3 months, something like that in the future where the option expires and ceases to exist. Oh, by the way, if there's any subscripts on your strikes, so if you see XL or XM or XH, then we're referring here to the relatively obvious fact that there might be a low strike and a high strike, maybe a mid strike if there's 3, and we're just denoting each one with the relevant subscript. Now, exercise style. European style options can only be exercised at expiry, whereas American options can be exercised at any time. All right? European, E for expiration, A American, A for any time. So there's a bit more flexibility about American options, which means they shouldn't be worth less than European options. But it's usually irrational to exercise American options early. It's that sort of technical point that was more interesting and more discussed at, say, level 2. At level 3, it's more about strategies and applying options to get a desired investment result, rather than the technical details of pricing itself. Okay. Now, a key feature of an option is what it's worth, its premium, its value, its price. Okay. So this is something that is very important to realize, that with an option, the buyer of the option pays the premium, that's the price of the option, to the seller, usually at the outset. All right, the default assumption is at the outset. So right now, if you want an option, you have to pay for it. All right, you pay a premium, just like you pay a premium for insurance. It's a very useful analogy, that, because you pay a premium for options as well, and if you need them, they're there for you, okay, as a holder of them. But if they're not there, well, if you don't need them, you don't get your premiums back. That's an important, that is an important feature of options. If you don't end up needing them, exercising them, you don't get your premium back, okay? Now, the buyer takes a long position in the option. They've got the right to exercise it. Don't forget, a call you'd exercise if prices go up. Buy here, something worth more. A put you'd exercise if prices go down. Sell here, something worth less, okay? The seller of the option is taking the other side. So for every long in a call, there must be a short call selling to them. All right, that's the long and short of it. For every long put, there must be a short put selling to them. So that does mean there's 4 option payoffs. There's long call, long put, short put, and we'll discuss all those 4 payoffs in this particular section. Okay. Don't forget that the buyer's got the right to exercise the option. That does lead to an obligation on the short side to fulfill that transaction. So if you sell a call to somebody else, that other person has got the right to buy. If they choose to exercise it, you have the obligation to sell to them. Okay? All right, yeah, so selling a call, you must deliver the underlying out. In other words, sell it out if the buyer exercises at the strike price. If you sell a put, then you have sold the right to sell. So somebody can sell the asset to you, right? Put the asset to you, and that involves you taking delivery of it, all right, if the buyer exercises. But that's only if the buyer exercises. The best thing that can happen for the short is that the buyer of the option doesn't exercise the option and the option expires worthless and the short side keeps the premium. Okay. All right. In terms of that premium that we've just discussed, that premium is usually a small fraction of the underlying S asset price value. All right. So your premium might be something like 8 on an underlying asset that's worth 68, something like that. So you can see that the premium of the option is relatively small relative to the underlying asset price usually. Okay. This premium can be broken up into two components, the intrinsic value of the option and the time value of the option. So this is really thinking about where what the components of that premium actually are. What drives intrinsic value? Well, intrinsic value is really just the value from exercising the option right now. So it's a function of strike price of the option and the price or level of the underlying. So stock price or currency rate or interest rate of the underlying asset. So intrinsic value is really driven by where the strike price is relative to the underlying, or actually probably better put, is where the underlying is relative to that fixed strike. Okay. If there is profits from the exercise decision right now, then that option will have an intrinsic value. If that fully explains the option's premium, then the option's got no time value. But any option that is not yet at expiry, any option where there's time to go to expiry is likely to have time value, some time value. Time value is all to do with the fact that the stock, the underlying asset, whatever it is, it could move further into the favour of the holder of the option, and therefore that option retains some value because there is some time to go before expiring. Time value would be 0 at expiration, but prior to expiration you would expect there to be some time value in the option. Time value is a function of obviously of time to expiration, but it's also a function of how far the underlying asset could move between now and expiration. So that's where the volatility of the underlying asset S comes in. All right, the volatility of the underlying. So sigma is standard deviation. Don't forget standard deviation and volatility, same thing. All right, sigma S is the label that we use for the volatility of the underlying. Also going into time value is the risk-free rate, because that is reflecting the time value of money between now and expiry, and potentially any yield that is earned, any benefit of carry going on between now and expiry on the underlying. What will also affect the value, the premium of the option, is whether it's European or American. As I alluded to earlier, generally this isn't a technical level, so you're not being asked to formulate premiums, you're not being asked to price options, you're not being asked to use Black-Scholes or anything like that like you were at level 2. But more generally, at level 3 you should be aware that American options tend, they can't be worth less than a European option. It doesn't tend to be massively valuable, the right to exercise early, because that's what an American option brings with it, on top of a European option, is that it's got the right to exercise early to the holder. That right to exercise early is not usually massively valuable, but and therefore the American option might be similar to a European option, but there are some exceptions to that rule where the American option could be more valuable than the European option. But that's really a technical point that we don't really focus on massively here. Now, whilst the volatility of the underlying is used in option pricing models to get out the option premium, we could always look at the option premium and back out what the market's view on volatility over the life of the option is. If you like, we can always look at the option price and back solve for what the market's view on volatility is. This is what's called implied volatility. Using the options premium or the options price to estimate the volatility of the underlying from the current option value. All right, so we're backing out, really this is the market's view of volatility given the option's value, given its premium. Okay, so implied volatility is something that is priced into an option by the market, and the general idea is that if the market doesn't think there's going to be a lot of volatility, then implied volatilities will be low. Now, if you have a view on volatility that's different to the market, maybe you could trade options to take advantage of that. So we'll look later on at option strategies that trade volatility. But just be aware of that definition for now. All right, this is a forward-looking estimate, all right, because the market should be thinking about what volatility is going to be looking forward over the life of the option, rather than what the historic stock price movement has been necessarily over the last 3 months, something like that, whatever the relevant period is. Okay, so as we've already discussed, the intrinsic value of the option is the value of the exercise decision right now. So if you think about it, intrinsic value will be positive for a call when the underlying is above the strike. We buy here something worth more, buying low, something worth more. That is the intrinsic value of the call. So when the underlying is above the strike, a call will have intrinsic value. In this case, the option is said to be in the money as well. All right, a moneyness comment where the underlying is above the strike, a call is in the money. This is me talking about a call here. If it's a put, it's the other way round. When prices fall, all right, you get to sell at the strike, something that's worth less. So that's when a put would have profits from the exercise decision. Sell at X, something worth less, S is lower. Okay, that is when their put is in the money. I think the slides, I think that's on the next slide, but we'll reinforce that on the next slide. So intrinsic value is just really whether there is any value from immediate exercise. And you can tell whether that's true or not simply by looking at S versus X, what the underlying spot asset price is versus the strike price. If there's any time to go in the option, it will likely have some time value as well. All right, so if we have a premium, just to give you a basic example, we did say that this option here had a premium of 8. Let's say that this option is a call option. It's got a strike of 15, say. Well, let's say it's got a strike of, yeah, why not, 15. So that's X, and the underlying is at 21. Okay, so with intrinsic value, you can see it just by looking at the underlying S, that's the underlying asset, it's worth 21, and the strike of the option, which is 15. So this is a call. You've got the right to pay 15 for something that's worth 21. Pay 15 for something that's 21. That's got intrinsic value. The profit from exercising right now is 21 minus 15, which is 6. Okay, so that's the intrinsic value, 6. Does that fully explain the value of the option? Well, no, the premium is 8. What you can do at this stage is just say, well, the balance, therefore, must be time value. So time value must be 8 minus 6, which is 2. And bolt those two together and you'll get the 8 that makes up the options premium. So that's just a very basic example of intrinsic value and time value. Okay, so pushing on here, generally speaking, the more volatility there is in the underlying, the more the underlying could shoot up and benefit call holders, or shoot down and benefit put holders, so the more valuable both calls and puts become. So there's a direct relationship between the volatility in the underlying asset and the value of options to buy calls and to sell puts that asset at a fixed strike price. Generally speaking as well, less time to expiry tends to lead to lower valued options. So if you've got an option for a week, that's not likely to have as much value as an option that you could exercise over the next month or so. So generally speaking, less time to expiry, lower valued options, more time to expiry, more valuable options. However, time of course runs out, doesn't it? We approach the expiry of the option, time runs out. So whilst we've got a direct relationship between amount of time and amount of value, we tend to just take the default view that time is going down, right? So there's, as we'll see later on, we talk about the time decay of an option, how much the option loses in value as each day passes. That will come later on. All right, so as we know, this is a bit of a redundant slide given our discussion. If this is a strike for a call, we would pay this strike when the underlying is above the strike. We'd buy here something that's worth more. So yes, if the underlying is above the strike, the option's in the money, it's got intrinsic value, and the intrinsic value is how much S is above X. It's said to be out of the money if the underlying price is below the strike, because you wouldn't pay, what was that strike before? 15. You wouldn't pay 15 for something that's only worth 10. All right, so you throw the option away, and it's worthless and said to be out the money if it's at expiry. Okay. Puts, it's the other way round. In the money if the underlying is below the strike, so you get to sell high something that's worth less. Okay, so if the underlying is less than the strike, and it's out the money if the underlying is high, because you wouldn't sell at 15, for example, something that's worth 20. All right, out the money if the underlying price is above the strike for a put. All right, now what you're going to see with the strategies that are going to come up in this section is you're going to see that we're going to talk about the cost of getting into these strategies, profits at expiration, maximum gain, maximum loss, and break even. Break even is where your net profit is 0 on the strategy. Now there's different ways of coming at this. We're going to see several strategies, and there's different ways of coming at it. You'll see the curriculum comes at it in different ways. There's formulae that you can remember for break-evens, maximum gains, maximum losses. There's even a pictorial way of drawing these strategies to see what's going on. We have, in the Schweizer notes, we have faithfully reflected formulae and graphs, but from a kind of a tuition point of view, really the encouragement is to take a more fundamental approach to these strategies, to understand what they're trying to achieve, to be able to sketch and see what these strategies do in terms of the payoffs that they offer, and to use almost common sense, once you know the basics of options, almost common sense to get out what the maximum gains, maximum loss, break-evens must be. You'll see this as we apply this fundamental approach across the different strategies. Okay, so I would steer you away from learning formulae. All right, formulae are probably not for the win here because there's lots of them and they all look similar, and by the end of it you can't remember which one's which. And the big problem with formulae, when you're finding that you're trying to learn them rote, is that you're missing the point. If you're trying to learn formulae rote, you're completely missing the point. You need to get behind the formula, understand what's going on, and then the formula succinctly summarises what's happening there, and you use it as a memory aid, not as a primary kind of knowledge reference. So we're going to be, in the modules that follow, we're going to be sketching out these strategies. Incidentally, I should point out you've seen a lot of them before. Bull, bear, spreads, straddles. You've seen a lot of these things before. And we're going to sketch them out, and we're going to deduce all the information we need just by basic sketching. And we're not going to spend too much time worrying about formulae. Okay, so talking of basic sketching, let's conclude this module by getting our basic option payoff, what they call hockey sticks, those basic option payoff diagrams in place. We'd have done this at level 1, did it at level 2. Let's do it at level 3 as part of the refresher as well. So let's take a basic call. Here's a call. We're going to take a long position. The underlying is called XYZ. All right. The expiry is May, and there's your strike there. The strike is 50. Okay. So what does this look like? Well, first up, we are going to need to pay a premium for that. So the cost of this position is 6.26. Now the general idea, you've got the right to buy at 50, this underlying asset. We don't know where it's going to be, but if somebody says it's above 50, you know you'll choose to pay 50 for something that's worth more than 50. All right, so if the underlying is bigger than 50, it's in the money and you will exercise the option. If the underlying is less than 50, you'll throw the option away, you'll throw it in the bin, and yes, unfortunately, you might think, well, that's great, no downside, but you did pay 6.26 for this option to begin with. And as an option buyer, all right, you always pay this. The idea is that you make more than that premium back through the exercise decision. That's the idea. You need to make more than $6.26 through exercising the right to buy at 50, this underlying thing. If you don't make more than $6.26, then you don't get your premium back and you make a loss on the option position. Okay? Let's have a look at some ideas. Yeah, okay, so we're just really extrapolating these basic ideas. If the underlying falls to 40, we do not exercise our right to pay 50 for something only worth 40. We throw the option away and it's worth nothing at the end. That means we've lost our premium. We've lost $6.26. However, if the underlying goes up to 60, do we exercise our right to pay 50 for something worth 60? You bet. So pay 50 for something worth 60. That's an exercise profit of 10, but don't forget you pay your premium on that. So we need to take off $6.26 to get our net profit. Okay? So the general idea here is, when we think about profits, the general idea, and this is for any option really, long, when you hold it, you're looking at the exercise profit, and you can't have negative exercise profit. I should have said that with intrinsic value. You know, intrinsic value can only be positive because the opposite of exercising the option is not, buying something above where it is. You just throw the call in the bin, for example, and you have zero intrinsic value. So the profit at expiration is the exercise profit, which is either zero or positive, minus the premium. And the idea is that through the exercise, you get more than the premium back. That's how you get a net profit on an option position. So if the underlying's at 40, do you exercise it? No, there's no exercise profit. All right, you don't pay 50 for something that's only worth 40. And there's your premium, which you always pay. And there you go. You've lost $6.26 on this option, okay, because you threw the option in the bin at the end. It was worthless. However, you did pay $6.26 for it at the start. If the underlying's worth 60, all right, so it's expiry, then yes, the exercise profit's going to be 10. That's great. And that does more than outweigh the premium, which you paid at the outset, is always paid. So your net profit is $3.74. Okay? Now, that's a long call. I would encourage you always to think about the long side. The short side, you can then just negate it. All right? So just turn it round. Instead of a loss of $6.26 on the long side, it's a profit to the short side. All of these options are zero-sum games. So if the long's pain is the short's gain and vice versa. Okay? So you can just negate these numbers if you like, or turn them around in terms of profits and losses. The break-even is where they draw, the long and the short draw at 0-0, 0-0. So the sum of the strike price and the premium, this is where the holder breaks even, and therefore the short breaks even as well. And this is at the strike price plus the premium. When the underlying has gone up to a value which is the strike plus the premium that you paid at the outset, then will you exercise it? You bet. You pay 50 for something that's worth 56.26, but the 6.26 profits go towards the premium and there's zero profit overall. Now it might be worth, I think, sketching this out. All right? It might be worth just picturing what's going on here. So what have we got? So if I put on the x-axis here, if I put S, and we'll assume this is at delivery, all right, so the underlying asset price at delivery. A key point on this line is the strike, which is 50. What we know is, this is a call. What we know is that when the underlying is below the strike, all right, there's the strike, 50. When the underlying is below the strike, we do not pay 50 for something that's below 50. So we throw the option. We think about our net profit. We throw the option away when the underlying is below the strike. We do not pay 50 for something that's worth less than 50. Now you might think, why are we below the line with net profit wise? Well, this is you losing your premium, because you paid $6.26 for this option and it expired worthless, so you throw it away. You don't exercise it, so you throw it away. Now every dollar that we go above 50, we get $1 of exercise profit, and there comes a time when we break even, and then after that we make a net profit on the option. Okay, so this break even here, as we've just seen, this break even is 56.26. More generally, it's the strike plus the call premium. Okay, that's where you break even, because at that point you buy at 50 something that's worth more than 50 by the premium, that profit, which is the premium, goes towards paying the premium, and you have a net break-even zero profit position. So there's your net profit on a long call, and it should be very familiar to you. That's a long call hockey stick. All right. We'll just briefly note here that the maximum gain is unlimited, potentially unlimited, because there's no ceiling on how high the underlying asset can go. But the maximum loss, like for all long position holders, the maximum loss is just the premium that you paid, because you can't be forced to exercise anything. Your maximum loss is the premium paid. And that's the point, I think, that the next slide is going to make. Maximum profit, long call, unlimited. Short, well, and stay with the long for the time being, folks. Stay with the long for the time being. The maximum loss is the premium paid. All you need to do is negate those to think of the maximum profit and the maximum loss of the short side. Okay, so don't forget, if the long maximum loss is 626, that must be the maximum gain of the short. All right, and for the long, if their maximum upside is unlimited, that must be the maximum downside for the short. In fact, you know, the easy way to think about the short side, this is my advice to you, the easy way to think about it is to just really negate the long side. In other words, flip it over in a kind of the x-axis. So generally, if you're comfortable that a long call looks like this, all right, there's the strike there. Whenever lines change direction, that's the strike price. And the horizontal axis here is the underlying. The vertical axis is profits, really, net profit. If you're comfortable that a long call looks like that, you can just say, well, a short call must be a mirror image in the x-axis, all right? If we drew it, it would look like this. You'd keep the premium as long as the underlying is below the strike, but then you'd start losing money due to exercise when the underlying goes above the strike. So there's your long call and your short call payoff diagrams. Okay, now we're going to put our puts into the picture. Okay, a put, of course, is the right to sell. So let's have a right to sell XYZ in June, different expiry, but same strike. We can sell at 50 here. Okay, the option premium is $4.88, so that's always paid by the long. All right, and the idea is we need the underlying to fall by fall enough such that we get that premium back and some, and then we're in profits under the put. So if the underlying's below the strike, we'll exercise our right to sell at 50, something that's worth less, and the option's in the money. If the underlying goes above the strike, we won't sell at 50, something that's worth more, and we'll throw the option away. It's out the money, it's got zero intrinsic value, but we lose our premium in that case. So, for example, if the stock goes up to 60, we don't sell at 50. Don't forget that's the strike. We don't sell at 50, something that's worth more. All right, so we throw the option away, and the option is worthless. However, if the underlying goes down to 40, that strike of 50 is looking good now. We sell at 50, something that's worth less, and our exercise profit is 10. But that's just exercise profit, not net profit overall on the option. When we think about net profit overall, we have to factor in the fact that we've paid $4.88. So the slide's not doing it there, but net profit-wise, same as before. It's the exercise payoff minus the premium. Well, look, if the underlying goes up to 60 and we don't exercise the option, that's going to be 0 minus 488. So there you go. You lose your premium if the option expires worthless. Net profit here, when the underlying has gone down to 40 and you exercise your right to sell at 50, you make exercise profit of 10, take off the premium of 488. You always pay the premium. Never get your premium back unless, well, you never get your premium back. It has to be more than covered by profits from the exercise decision. So 10 minus 488 is $5.12. That's your net profit on this put. And it might be worth just sketching this put briefly, like we did for the call. Like I say, you've seen this stuff before. All right, there's S, there's your net profit on the option. There's the strike of 50. So what are we doing here? We are going to say that when the underlying is above the strike, we do not sell at 50, something that's worth more. So we throw the option in the bin, and that's us losing our premium. That was 488, wasn't it? 488 loss. When the underlying goes below the strike, we start selling at 50, something that's worth less than 50. We start making profits from the exercise decision, and this gives us our payoff. This gives us our net profit. We have to go now where we break even here. This is where the underlying has fallen by the premium, isn't it? It's where the underlying has fallen below 50 by the premium amount. So when we sell at 50, something that's worth 50 minus the premium, we make that premium value, and then when we take off the premium from that, we end up at 0. So that's your break even. Break even here, break even is strike minus the premium. You need the underlying to go down. Right, below the strike, when it's gone down by the premium, you sell here something that's worth less, and that profit pays for the premium, and you break even overall. You might notice here that as a long put, your maximum downside is the premium again, and you can take that away. The long's maximum loss, whether it's a call or a put, is just the premium that was paid at the outset, because the worst that can happen is you just end up with something that's worthless. You don't have to exercise it if you don't want to. But you might notice that it's not unlimited upside here for the long put holder. It's not unlimited upside. And the question is, what's the maximum gain here? Well, one of the things that is useful, this might look like a bit of overkill here, but one of the things that's very useful when we're doing strategies, when we're thinking about strategies later on, is to use what I call the triangle rule. Whenever you see a triangle in these strategies, because there's only one, because there's a direct relationship between the option when it moves and the underlying, all of these lines are 45-degree lines. The important thing means that all of these vertical distances are the same as these horizontal distances when you find a triangle. So for example, that distance there of 488 is the same as that distance there, 488. And we knew that, didn't we? Because this break-even is 50 minus 488, the premium. Similarly, there's another triangle here. This distance here, well, what is that? Strike minus premium, whilst I've said what that is, I haven't actually bothered to write it on. So the break-even here, strike minus premium, is 50 minus $4.88. That's $45.12. All right. That's where we break even. When the underlying is at 45.12, that's when we sell at 50, something that's worth 45.12, we make 488. That just pays for the premium, so we break even. Now, this gives us this distance here. We know that this distance here, by definition, is 45.12. That's what the break even is. It's the underlying price when we make 0 net profits. Now, if you know that distance, given the 45-degree rule for the triangles, you know that distance as well. It turns out that is the maximum gain. Okay, that's a quick way of seeing it. You look for a triangle and you realize that any horizontal distance is the same as a vertical distance and vice versa. So you can navigate through these triangles and get your maximum gains, break-evens, maximum losses very, very quickly. And that would be the way I recommend you attack this particular section. Of course, fundamentally, you could say, well, look, if you could always derive this fundamentally. If you're long the right to sell at 50 and something goes to 0, this is where the underlying goes to 0, you sell at 50 something that's worth 0, so you make 50, take the premium off, because you always lose your premium, and you get back to 45.12. That is something that you could do from first principles. That's maximum profit, and that's what they've done here. All right, we've derived the break even, we've derived maximum profit. Okay, and for the long put, the downside is always just the premium paid. That's the same for both calls and puts. And don't forget, the maximum profit to the short put is essentially the maximum loss to the long put, zero-sum game again. The maximum the maximum loss to the short put is going to be the maximum gain to the long put. All right, so once again, it's just negating the positions. And for me to complete the picture here, let's go back to this graphic. We can now put on here the other two option payoffs that we are interested in this basic section. We've got our puts. You know, a long put is a hockey stick that goes up as we move below the strike. Don't forget the implied horizontal axis here is the underlying. When we go, and whenever a line changes direction, that's a strike. So when the underlying goes below the strike for puts, that's when we start making profits. That's a long put. If you negate that, then you're looking at a short put, which gives us this nice kind of symmetry. Okay, and that's what I always have in the back of my mind. This is not one chart. This is 4 different charts, but all in one place. If you like, there's little axes here for this one. There's a little axis here for this one, and so on. There's 4 different charts, but they're all in the same place, and it gives me the basic shape of my basic option positions. So that's kind of in the back of my mind. If somebody says long call, I know it's this thing that wins as we go above the strike. If somebody says short call, I turn it round. We lose. If you're short a call, you lose as the underlying goes above the strike. Long put, I know it's the thing that wins as we go below the strike, as the underlying goes below the strike. And short put is the inverse of that. It turns out that a short put loses as the underlying falls. Now, I would always advocate appreciating the long position, because that's intuitively the one that, if you like, it's most accessible. You can then just negate what you see, turn a profit into a loss, turn a positive into a negative, to think about what happens when you sell those options. The thing about short option positions is that they have very large downside. You know, I've kind of drawn these arrows into this kind of pit of despair here. You can lose a lot of money when you sell calls and the underlying goes up. You can lose a lot of money when you sell puts and the underlying goes down. It's not an unlimited loss, but it is a very large loss. That's not the case for long options, where your maximum loss is limited to the premiums, of course.